I think everybody knows stock market is near an all-time high. Had a drop in the fall, but it seems to be coming back, and we've gained a lot of that was lost then. You know, the best way to make money is to buy low and sell high. The market's high. You know that, right? The market's high. So what should you do? You know, especially if you're thinking about retiring in the next 2 to 5 years. What should you do? Well, listen up, and we're going to talk safe strategies. I'll explain that acronym to you when we come back.
Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
Well, I appreciate, as always, you joining us this morning. Today, I hope I come up with some good information for you, especially if you're invested in the markets. You know, you may be very happy today, but what about the future? You know, we're in the longest run in stock market history as far as length of time of it going up. Now, that doesn't mean it's going to go down right away. But today we're going to talk about safe investment and safe retirement strategies. Now, what do I mean by that? Am I talking about sticking your money in your mattress or putting it in a safe deposit box or some crazy stuff like that? No, SAFE stands for sound advice for everyone. Doesn't matter whether you're a novice investor or one with decades of experience. Doesn't matter if you're wealthy or of modest means. And it doesn't matter whether you're in the growth stage of investing or in the income distribution phase of retirement. This is sound advice for everyone. And, we'll just call that safe strategies because they cover all the phases of your investment life. Now, why safe? Well, common sense, sound advice for everyone, but they're defensive in nature. And they're inclusive of all types of investment strategies. One of the keys of a safe strategy is having a full financial plan. You know, it's important to know that many financial advisors today are really financial salesmen and financial saleswomen. What you need is a financial Sherpa. And I'm not talking about a financial salesman. I'm talking about a financial Sherpa. Now, what is a Sherpa? Well, a lot of you know that's one of those guides in the Himalayas that takes you up to Mount Everest or some of those other peaks. And they guide you up and they guide you down. And that's good analogy for your financial life because as I've covered in other shows, the retirement mountain, you have the ascending phase, which is the accumulation phase, and the descending phase, which is a distribution phase. The key is not just building it up, but making sure you have enough money to get all the way down. Making sure you got a paycheck for your life and that you're not running out of money before you run out of life. And, there's a lot of strategies you can use to do that. You can go for growth till about 5 years or so before retirement. And that makes sense. And then switch into a plan where you're needing to draw income. But when you're thinking about retirement, when you're within, that 5 years or so of retirement, can you afford to lose 25 or 35% or more as we did in 2008 and 2000 if we have a major market decline? And again, remember, I said we're in the peak of the market. And what do they always say? Buy low, sell high. Now, again, I'm not saying you should go out and sell everything. Your situation is based on your situation. And that's something that requires discussion and investigating. But when you think about it, different types of advisors, there are some really good advisors that are great in that growth phase. They pick the right funds. They're there for that long period of accumulation where when the market goes down, it actually works for you because of dollar cost averaging. but they may not be that advisor to get you through the retirement phase of your life. So when we come back, we're going to talk a little bit more about that.
Thanks for listening to today's program. As a bonus, we're offering a free copy of Turning Financial Planning Right Side Up by Jeff Small. Turning Financial Planning Right Side Up reveals exactly how Wall Street, financial planners, and the news steer investors into poor and expensive decisions. Here's what actual readers have said. When it comes to making sure you can retire and stay retired, I would categorize Small's book as real news. Jeff has nailed it. A must-read for anyone in or approaching retirement. I highly recommend this book. Turning Financial Planning Right Side Up by Jeff Small. Available free right now. Be one of our first 3 listeners right now to call 844-343-6048. That's 844-343-6048. A great book at a great price. Absolutely free to our first 3 callers. 844-343-6048.
Coming back, we talked about 2 investment periods, the accumulation period, the distribution period. And most people use a financial advisor of one sort or another. Some do it all themselves. Some do it really well by themselves. But when you get from point A to point B, which is that accumulation, oftentimes that advisor may not be the right one to take you from point B to point C, which is the retirement phase, and takes you near death, leaving a legacy, those type of things. So again, it starts with safe investing, and that's what I mean by safe investing is sound advice for everyone, and it starts with having a written plan. Because you know what? If you don't have a plan, you're just winging it. And you may think you're conservative, moderate, aggressive, but if you don't have a plan, you're really just gambling. It's like going to Tunica and letting the money ride and feeling good as long as it's growing. But as you start losing, you get more risky and risky because you got to get it back. That's not what I'm talking about. I've heard many times over my 31 plus years that people say investing in the markets, whether it's stock mutual funds or bonds, bond funds, ETFs, is gambling. But what I'd say is those comments are probably made by people who haven't taken the time to come up with a comprehensive strategy or didn't take the time to find someone who can help them come up with a comprehensive strategy. So when we talk about safe, sound advice for everyone, what I'm talking about is taking appropriate risk versus gambling. Gambling's a game of chance. You roll the dice, you hope it comes up to you. There's a reason the casinos are nice and have cheap food. It's because the odds are in their favor. And a lot of people would say, well, the odds are in Wall Street favors too. Well, in a way they are. If you continue to invest at, say, 60, as you did in 40, then you are playing with the house odds. That's why having a different strategy when you're in that transition into retirement and in retirement is so important. So when you talk about investing, like I said, gambling's a game of chance. You either win or lose. You bet on a football game, a horse race, but you don't really have an influence in that. You're just betting. There's no chance for you to succeed other than plain and simple luck. But investing is you're choosing to participate in the growth or income of a company and a group of companies, if we're talking about mutual funds. You can look at daily prices, daily valuations. You can choose when to put money in there. And equally, more important, is when to sell and get out. So it's not really like gambling because once you're gambling and you're in, you're stuck. So, it's a whole different thing. So having a strategy on the exit is very important because you could be doing really good, But like so many people, you don't have an exit strategy. Yeah, you thought, well, when the price gets to this per share, I'll buy it and I'll hold on to it, but haven't really given a thought to exit strategies. So, you can ask your advisor, and I would recommend you do if you have one and you've got some stocks you've held for a long time. What would make them tell you to sell your Apple or your Vanguard fund? And what I would position to you if they start talking about trade war with China and tariffs and the election, maybe they don't know. Maybe they don't know how to protect your capital. That's a huge problem. You got to have a reason why the money's in there. And you got to know also when you need to take the money out. And when we come back, we're going to talk about that.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Today on the Ask Brad show, Brad wants to make sure he gets something of value into our listeners' hands. And so he's put together a report called The Guide to Aging. We're all living longer, and that makes retirement even more challenging. But in this very informative guide, Brad's put together point after point after point of things we're all going to have to deal with, like claiming our Social Security, getting ready for RMDs, and estate planning, and so much more. For your complimentary report, The Guide to Aging, give Brad a call right now, 844-343-6048. That's 844-343-6048. We're all going to be living longer, and that's a good thing. But that's also going to present some challenges. Educate yourself today. 844-343-6048. That's 844-343-6048.
As we come back, you got to know when to exit. And there's got to be a sound reason for that. And that's why you've got to have a purpose-driven plan. And I've done a show on that if you want to go back to the old shows and look at them. And I'd recommend you do that. If you listen to the show and you find it beneficial and you find it informative, go to the AskBradShow.com website. And that's AskBradShow.com. And you can listen to some of the old shows. Again, today we're talking about safe strategies, sound advice for everyone. As we were talking about is buy and sell discipline. You got to know why you're in, and you got to know when it's time to get out. One person might be 45 and investing for maximum growth. Great. Somebody might be 66 and get ready to retire. So they need to draw down to maybe delay Social Security. Knowing why you're investing and what the purpose of that is very important, because it shifts you from a performance-based mentality to a purpose-based mentality. And that's the key. That's one of the outcomes of having a written plan, is you're knowing when the forks in those roads are and that you're going to need to make a different strategy. You're going to hear me say in this show and in many shows about purpose-based investing. And that's a sound part of the sound advice for everyone plan. You may have a strategy that says, well, I want to beat the S&P 500 year in, year out. And you're going to need to get about 10% over time. That's another show entirely about stock market history. But you're also going to have to realize that you may have a 35 or 40% or more drawdown about once in a decade, because that's what the stock market does. And so, we have bear markets, we have bull markets, we have secular bear markets, which are your long-term bear markets, secular bull markets, which are long-term, and cyclical. You can often, even in a down market, you can have up and down markets. So here we are in one of the longest bull markets of stock market history. And the question that everybody needs to be asking, Are we closer to the beginning of it or to the end of it? So is there a day of reckoning coming, or is trouble already brewing? That is why making the change to purpose-based investing makes so much sense and is part of a safe plan. Sound advice for everyone. So whatever stage you're in, midlife, still growing for maximum growth, near retirement, but wanting to protect what you have, maybe get a little more, it's good to have a safe plan. It's good to have a purpose-based plan. So what is that strategy? It's a strategy that's based on your needs, based on your goals, and not some buy and hold and see what happens and hope for good luck strategy. You know, how many times have you known people that bought a share at $10, it went to 20, 25, 30. They're just ecstatic. And then it starts coming down and they're locked into it. They've got this emotional attachment to it. And they watch it come through the $10 a share. And then they're wondering, now I got to hang on to it. Because they didn't have an exit. They didn't know what the purpose of that was. They had not written it out. You ask people, if you're close to retirement, then you went through 2000 and 2008 and how that made you feel. I know you probably knew people that extended their retirement because of those two dates, or one or both of them. So it's very important, again, to be thinking about safe strategies, sound advice for everyone, and having a purpose-based financial plan. What I'd like to do is got a free report, which is along the lines of what we're talking about today, the guide to aging, making the right decisions at these milestone ages. It's a free report that we'll get out to you, email it to you, mail it to you, whatever you like. Just give us a call at 844-343-6048. That's 844-343-6048, and ask for the guide to aging, and we'll get it out to you. No cost, no obligation. You know, we're not going to try to sell you something. We just want to get this information out. I think that's one of the biggest things I like to do with my show is get information out there. I mean, it's great if you call and you want to come see me, but what I try to do in this show is give back to this great community that's given to me a successful business. You know, it's all about reciprocity. I think it's all about what you give in terms of what comes back to you. Call in 844-343-6048. Get the guide to aging. It'll help you through some of these milestones. So let's get back into safe strategies and purpose-driven strategies. And again, as I mentioned very early, got to have a written plan, got to have it in writing, and you got to have goals. Now, you may have written one out, and that's great. You're ahead of most people, but you got to stick with it. And I've done shows on financial GPS. A financial plan should be like a GPS because things happen. You know, you may have to take a detour and it redirects you and takes you back on course. It's like being in an aircraft. You know, you get on that airline, you're off course most of the time. It's just that GPS brings the nose of that aircraft back on heading and keeps you on a path to where you want to go. So when I say safe and when I talk about defensive, what I'm talking about is, like I said, not putting money in your mattress or in a safe deposit box. It's not looking at annuities. Annuities have a place. A lot of times when you hear safe money, you can be assured that what's getting ready to happen next is an annuity pitch. And I'll be frank with you, annuities get a bad rep from Wall Street because they don't like them. And annuities don't fit everyone. So I'm not sitting here pitching annuities. But oftentimes when you say safe, that's what people think of because that's usually what is in the next breath when you talk about that. That's not what I'm talking about. I'm talking about sound advice for everyone. Again, having a written plan and sticking to it, having goals, having milestones, having regular reviews on that plan. That plan, when you start working with a financial advisor, I personally use a special planning software that goes through a process with my clients, and we develop a plan and then stick to it. And that becomes the basis of our reviews, is how we doing according to the plan. To me, that's a great tool to be a Sherpa, to not be just a financial salesperson. You know, when you go into a financial review with an advisor, the purpose shouldn't be that, oh, you got some cash sitting around, we need to do something with it. It should be, are we on course? And what do we need to do to adjust that plus or minus to make sure we stay on course? So as we get back into one of the key things that started this conversation was we're in a long running bull market that's pretty long on the tooth. Now, I know a lot of you out there were smart enough to get out before the last two and didn't lose 50, 60%, but many of you didn't. And so it's having an exit strategy, knowing why your money's in there, that's very, very critical. So how do you do that? Well, it's a matter of balancing your investments, because so often when you go in and you tell your broker, I'm a little cautious and I want to get more conservative. Well, because they're probably only dealing with mutual funds and stocks, they're just going to move you in more conservative mutual funds and stocks. But you're still in the market, and there are other tools out there. There are many tools that you can use to diversify your portfolio, to start de-risking it as you're in that retirement phase. So just remember that.
Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048.
All right. Now, we've been covering safe retirement plans, and that stands for sound advice for everyone. And what does that really mean? It means purpose-driven investments. It's not performance-driven. Yes, performance is critical. It is very important, but that should not be everything. It should be about making sure that the money's set up to do the things you need to do with it. So if you're always aiming for the fence, you're always wanting that home run, there's a common characteristic that home run hitters share, and that's they're strikeout kings. Good ball teams win games by base hits, and they just keep moving that ball and keep moving those players around the base, and they got constant pressure, constant push, constant points on the board, and that is a good solid strategy. Trying to pick the next Apple or the next Microsoft, that's not the way to invest for retirement. So when we're talking about safe, we're talking about sound advice for everyone, purpose-driven investments. When we look at what happens when you retire, you need a drawdown strategy. So often the time is spent on the accumulation part of it, but you've also got to have a drawdown strategy. There's been some changes in that. Used to be that everybody said, well, you could save $1 million, draw out 5%, and you have a reasonable chance, which was about 90% chance of not outliving your money. Then they drew that down to 4%. With the low interest rates and the fact that the bond market's got some issues coming up, when interest rates start rising, bond values are going to drop because the prices of bonds are inverse to interest rates. You have to rethink that 4%. In fact, Morningstar, one of the key proponents of that, is now come out and said 2.8%. So think about that. You got $1 million and they're telling you that at 2.8% withdrawal rate, you have a reasonable chance, roughly 90, a little over 90% chance of not running out of money before you live. And a lot of that's based on the sequence of returns. If you have your gains in the early years, then that can work out real good. If you have your losses in the early years of doing that calculation, it could be a disaster. So remember, safe strategies. It's all about having structure, having a written plan, and having purpose-driven investments. Now, one thing I want to lay out to you is one of the things I hear when a lot of people come in to see me for my show or from one of my workshops, and I'm getting ready to do one on required minimum distributions in February, so stay tuned for some information on that. But when they sit down with their advisor, they're really not covering drawdown strategy. They're not covering Social Security. They're not covering putting everything together in a written plan. It's all about returns. And as long as the portfolio has got a great return that year, then everybody's happy and they go home and they think they got a lot accomplished. But what it's really all about is looking at the roadmap. And if you're going from point A to point B, and that journey's 500 miles, you want to make sure you check in periodically to make sure you're on track. That's what an annual or quarterly or semi-annual reviews, because frankly, I do many different kinds. Do big ones on an annual basis and then do check-ins on a quarterly basis typically, just to make sure you're on track, just to make sure something hadn't changed in your family, in your life, with your health. A lot of things drive your investments. So folks, I cannot impress you enough. Make sure that you've got a safe strategy, that you've got a purpose-driven plan. Now, if you're not sure you do and you'd like to talk to me, we can spend 10 minutes on the phone. You can schedule free 1-hour consultation, no cost, no obligation. Just give me a call, 844-343-6048. That's 844-343-6048 and ask for the free consultation, and we'll be happy to give it to you. No cost, no obligation. Get to know each other, find out what you're looking for, share some philosophies, figure out if we might be a good fit. If that's something that interests you, give us a call, 844-343-6048.
At Brad Williams Financial Services, our goal is to develop enduring, long-term personal relationships with our clients, knowing that you have placed your trust in our expertise and dedication. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Thanks for listening to today's program. As a bonus, we're offering a free copy of Turning Financial Planning Right Side Up by Jeff Small. Turning Financial Planning Right Side Up reveals exactly how Wall Street, financial planners, and the news steer investors into poor and expensive decisions. Here's what actual readers have said. When it comes to making sure you can retire and stay retired, I would categorize Small's book as real news. Jeff has nailed it. A must-read for anyone in or approaching retirement. I highly recommend this book, Turning Financial Planning Right Side Up by Jeff Small. Available free right now. Be one of our first 3 listeners right now to call 844-343-6048. That's 844-343-6048. A great book at a great price. Absolutely free to our first 3 callers. 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working.
Well, welcome to another edition of the Ask Brad Show. Imagine this. You're over 50 years old. You've been married for 25 years. And now your spouse just drops a big bombshell on you. They want a divorce. Welcome to the new phenomenon, gray divorce. The key is, what does all this mean for your finances? And that's what we're going to talk about today. It's not the best topic to talk about, but it's one that affects more and more people. And that is gray divorce. Seems like every time we get a new phenomenon, somebody comes up with a name for it. Even though most people aren't gray after 50 anymore. I guess it's a miracle of modern chemistry. But let's talk about what that means. And family breakups are never good. And especially even at 50, sometimes you still have children in the home in one way or another. And that's always tough from a family standpoint. But what we're going to talk about today is, what does it mean for retirement readiness? What does it mean for your finances? Because these are questions that people need to know the answer to. Who knows? If they knew the answer to these questions, they might try to work it out and not get a divorce. But we're going to take a look at them, and we're going to break it down into categories. The first would be retirement readiness. What does a divorce after 50 mean to things like your pension, your 401k, things like that? We're going to discuss the ins and outs of that, and things like home ownership, because you've both been living in the same home. There's often a struggle who gets to keep the home. Does it make sense to keep the home? And we're going to discuss some of the details of that. With the new tax bill, alimony has become a whole different situation. So we'll look into that. And then Social Security, because Social Security, that brings in some new twists to an already complex situation. So we're going to get started right away, and we're going to take a look at one of the most asked about for those that I've met with who come in who are going through that phase. And that is, what is this going to mean to my retirement accounts? Well, I think undoubtedly the most important thing is it's going to put you at risk to not be able to meet your retirement goals in many cases. When you look at, you've planned on 2 incomes, maybe you've got 2 401ks, 2 pensions, that Social Security combination, all those things where you've sat down and you've figured out where you're going to be at retirement, that's all changed now. In fact, interesting statistic is that divorce has a greater impact on couples who have remarried than individuals who remain single after a divorce. That's kind of an interesting statistic. And it's also estimated over half of American households approaching retirement have experienced divorce. So we need to take a look at that. So as I mentioned, pensions. And when we drill down into pensions, there's a lot of things you really need to know up front about how your pension is going to be handled. For example, maybe questions you should be asking yourself. Does your spouse have more than one pension? Does he have one with the current job, or she, or with a previous job? Next, have they worked long enough to earn a pension? Big question is, what's the accrued benefit? What's the accrued value of that? Because oftentimes that qualified domestic relations order is going to need to know that. What is the value of the pension, and what is that fair share? So having that pension valued is going to be very, very important. So you've got one big thing that falls into that, which is the qualified domestic relations order. And that's what's necessary to get pensions distributed. So what typically happens, as soon as the divorce proceedings start, your attorney contacts your spouse's plan and gets their quadro procedures. Every company's a little different, and some of them even have their own forms because they've done that so many times. And does the order, the quadro order is what I'm speaking of, clearly specify what amount is to be paid to you? And that's very important that your lawyer get that. And when is that payment eligible? Does the order provide for survivor benefits so that you can continue to get benefits if your ex-spouse should die first? In most cases, company pensions provide a survivor benefit 50% of the spouse's benefit. And even ex-spouses can receive them, but they must be specifically included in the quadro to get that. So remember that, when you're dealing with pensions, there are certain things that need to happen to make sure that that's done properly.
Today on the Ask Brad Show, Brad wants to make sure he gets something of value into our listeners' hands. And so he's put together a report called The Guide to Aging. We're all living longer, and that makes retirement even more challenging. But in this very informative guide, Brad's put together point after point after point of things we're all going to have to deal with, like claiming our Social Security, getting ready for RMDs, and estate planning, and so much more. For your complimentary report, The Guide to Aging, give Brad a call right now, 844-343-6048. That's 844-343-6048. We're all going to be living longer, and that's a good thing. But that's also going to present some challenges. Educate yourself today. 844-343-6048. That's 844-343-6048.
Investing in the stock market these days is like riding a roller coaster. Leaving a place of safety, get on the coaster, hear the clickety-clack as you experience anticipation climbing to the top of the hill, followed by sheer panic as you plummet back to the earth, hoping you stay on track. You might be brave enough to repeat the process several times, going up and down, but never achieving higher highs and accomplishing nothing but anticipation followed by fear. The stock market has been doing this same ride of volatility with no real growth. Proper education, though, can help you find a better way to grow your money during these times.
Call 844-343-6048. That's 844-343-6048.
Getting back to pensions and 401ks, and, frankly, with today's financial environment, pensions are becoming less and less common. 401ks are becoming the standard. So the key thing in there is making sure you divide it properly through a quadro. And remember, you just can't say, well, I really don't want to take it out of my 401k because it's doing well, so let me just write a check. Well, that's problematic in itself as well. So figure out how best to separate that out. If you're going to get a divorce, try, if you can, to sit down, have a meeting, and just list everything that needs to be divided and try to come up with some plan and some process yourself. And understand this may take several meetings if you're going that route, because when you get two attorneys involved, no offense to you attorneys out there, but then that adversarial relationship becomes even greater. I had a real good friend. They were both chiropractors. They had a very successful chiropractic practice. And unfortunately, they decided to get a divorce. They were from a small town down in Florida. They ended up fighting. And it seems like every time they came to an agreement, one of the other attorneys figured out that there was something wrong with it. It was almost like they called each other prior to the meeting and say, okay, who's going to object today? That's just joke fun, but think about that. And they ended up spending about $50,000 in attorney's fees to get a divorce. And it really hurt their practice because nobody knew whose it was, so they quit caring about it. And I'm sure their patients understood that. It ended up being a 2-year process that neither one of them have really recovered from emotionally or financially. So even though you may not be disagreeing on the big issues, try to work them out because it's going to pay off financially in the long run. So when you look at a gray divorce, what you're doing, you're splitting everything up. you may not have time to catch up financially to make your retirement what it should have been. So just keep that in mind as you're going through the process. Remember, your 401k, your IRAs, your Roths, and remember this too. A Roth IRA has already had the taxes paid. So, what you don't want to do is say, okay, I'll take the traditional IRA and you can have the Roth. I mean, you may want to do that, but you've also got to remember when you hand that Roth to that divorced spouse, you're giving them tax-free money. So you need to make sure all that comes into that calculation. And it's really a fine line that you've got to walk to make sure that everything goes the way you want it to, because, things happen. So just remember that when you're dealing with pensions, when you're dealing with IRAs, take your time, get some financial help. Good financial advisor might be able to give you some key tips on how to negotiate to make sure, you're not cheating yourself and you're not being cheated. So just remember that when you're dealing with retirement accounts, you're dealing with a lot of tax implications, and they've got to be done right, or else you end up with all kinds of issues. Now, next, I want to talk about home ownership. We'll briefly touch on this before we go to break, but, there may be a situation where one spouse really has an emotional attachment to the home, maybe because of children or whatever. And so then the negotiation comes how to split that up. You quit claim deed and all that. Remember a couple of key things that you need to understand going in. Now, you may understand these things and go along with them, and that's fine as long as you understand them. But things like the mortgage, maybe it's not an opportune time in a mortgage to refinance. Well, remember, if you've done a quit claim deed to give that house to that spouse and you're still on the mortgage, you're still liable for those mortgage payments. So remember that. Just like credit cards, you need to make sure that you've handled those credit cards properly, either froze them or closed them. And remember, when you close accounts, you're cutting off, especially accounts that have been there for a long time, you're cutting off credit points that are in your benefit. The longer you've held a revolving credit account and paid it in good stead, the more it helps your credit. So don't just go haphazardly closing everything. But getting back to the home, making sure that you may decide, well, in lieu of my ownership percentage in the home, I'll take some of your 401k. And just remember that when you do that, you're taking before tax money. So build that into your calculation. So there are so many things along those realms to take into account. Now, there may be some children left in the house, and leaving the children in the home to where they're less impacted by the divorce may be important to you. But just remember, when you're including that home in the calculation for a divorce, you take into account the mortgage, you take into account the value of the home, you take into account as the spouse who may be keeping the home. You're getting ready to accept a liability and an expense that was shared previously. So if you can afford it, great, but make sure you can. It could be that selling the home and downsizing at this point in time may make sense. And in lieu of the real estate market now, it might, depending on your situation, because home values have gone up. Just remember to keep all that into the calculations.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048. Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com.
Welcome back. We had been talking about the gray divorce, and we had discussed retirement accounts and the implications of splitting up retirement accounts, the implications of pensions, and how to take into account during your negotiation, during the process of how those should be split up. And the 401k, the Roths, how you need to make sure that you're taking into account the tax implications of each one as you're splitting those up. And next, I want to go into alimony because, alimony has been around for a long time. It was often used in a negotiation. It could be that in lieu of property, I would give my ex-spouse alimony. And now the tax implications of that have changed with the new tax bill. So you need to keep that in mind because it's not the clean thing it used to be. If you're going through a divorce and it's finalized by the end of 2018, the person paying alimony is going to be able to deduct that expense from their gross income. So if you've got a higher income individual, then it may make sense for them to pay alimony, and a lower income individual, of course, as they report it as income, they're going to be in a lower tax bracket, so it may not have the impact otherwise from a tax standpoint. So now after 2018. So as we go into 2019, people who are getting divorced in 2019 and who are paying alimony are no longer going to be able to claim that as a tax deduction. And what I mean is the payments they're making as alimony will no longer be deductible. In exchange now, the person receiving it's not going to have to report it as income. So as a result of this, a higher earning spouse, they may no longer be able to afford to pay as much alimony as they had in the past because they've lost that tax deduction. And that could leave the other spouse, typically a woman, in a less secure financial position. So, and then another key thing in the tax bill is these laws expire at the end of 2025. So, got to calculate all that in there. So remember, as far as alimony is concerned, that's a whole new animal now if you're not going to be finalized by the end of the year, which would be kind of tough in most divorce proceedings. So the rules of alimony have changed going forward. Now let's talk about Social Security. If you're divorced, but your marriage lasted 10 years or longer, you may not realize this, but you can receive benefits based on your ex-spouse's record. So there's a few key components of that you got to qualify for. First off, you got to be currently unmarried. If you've gotten remarried, bets are off. You got to be 62 or older. Your ex-spouse has got to be entitled to Social Security, retirement, or disability. And the benefit you're entitled to receive based on your own work is less than the benefit your ex-spouse receives. So your benefit as a divorced spouse is equal to 1/2 of your ex-spouse's full retirement amount, and that's at full retirement age. Obviously, you got to hit full retirement age to get that maximum benefit. And the delayed retirement credits don't affect the ex-spouse's benefit. And what I mean by that, if you're taking benefits based on your husband's Social Security and they're gathering deferred retirement credits, you don't get benefit of that any more than you would if you were married. Once you hit that full retirement age, that's the max benefit. So if you remarry, you're not going to be able to collect on your former spouse's record unless your later marriage ends by death, divorce, or annulment. So in that respect, you can't be married. You could have been remarried, but you can't be currently married. If your ex-spouse has not applied for retirement benefits but can qualify for them, you can receive benefits on their record if you've been divorced for at least 2 years. So that's a good thing. Now, if you're eligible for retirement benefits on your own record and your divorced spouse's benefits, they're going to pay the retirement benefit first. If the benefit on your ex-spouse's record is higher, you're going to get an additional amount on your ex-spouse's record. And so that way the combination equals a higher amount. So just remember that Social Security, You can collect on an ex-spouse's benefits. It does not affect their benefit. They may not even know you're doing it because it really doesn't affect them. It's a calculation based on you and based on their work record and their earnings. So remember that as you look at those things you need to take into account as you're planning for retirement and you're divorced. Now, as I mentioned, the tax laws have changed with the new tax bill, and that really affects everybody in one way or another, not just divorced spouses. And there's a lot of key things in there. Brackets came down, or I should say tax rates in those brackets came down. The standard deduction was increased. The personal exemption phased out. So these are some key things you need to know as you're looking at retirement, is what your tax situation is going to be. And I've offered this before, but I provide my clients what I call my key financial data sheet for 2018. And it has tax rate schedule. It's got standard deduction exemptions, tax rates on long-term capital gains, retirement contribution limits, Medicare premium brackets, the difference in Social Security, required minimum deductions, all this on a handy to use, 1-page, 2-sided, what I call my tax cheat sheet. And I would be overjoyed to be able to provide that to you. If you can call 844-343-6048. That's 844-343-6048. And just ask for the tax cheat sheet. Give us your email or your address. We can send it to you in digital copy or hard copy. No cost, no obligation, just as a benefit of being a listener to the Ask Brad Show. And I think you'll find it very beneficial. I've been using these for many years, and my clients look forward to getting them every year because it helps simplify their process and their planning for the year. So a real handy sheet. Again, just give us a call, 844-343-6048. That's 844-343-6048. Or you can send me an email at brad@askbradwilliams.com. That's brad@askbradwilliams.com. I'll send you a digital copy if that's what you'd like. Again, no cost, no obligation. So as we're wrapping up here, just as a quick overview, gray retirement's affecting more and more people, and having the right planning process. If you're going through that, it's already a tough process on its own, but make sure you're planning for your retirement readiness, that you've looked at the implications of pensions, of 401ks, of Roth IRAs, of 403bs, of all these things, and that they come into the planning process so they can be split up properly. Home ownership, who gets to keep it? If you've got equity built into it, how you're going to distribute that equity. Looking at alimony, you're going to pay alimony, you're not going to pay alimony. Remember, if it's done by the end of 18, it's got one set of rules. If it's done after January 1st, 2019, and when I say done, I mean finalized, then it has a different set of tax rules. Looking at Social Security and understanding that you do have some benefits there and that you can draw benefits from a former spouse if they were the higher income earner and they're going to have greater benefit than you. These are some of the things that really need to come into play. And, if you're going through this and don't have a financial advisor, would find it beneficial to sit down with one who has helped clients through this before, give us a call. I'd be happy to give you a free consultation, 844-343-6048. That's 844-343-6048. And if you know someone that's going through this, refer them to our radio show website, theaskbradshow.com. Typically by Monday or Tuesday after the show is posted, it's up on the website. You might just send a link to them, have them go to the website and listen to it. Hopefully they'll find some benefit in it as they're going through this really tough process, and, maybe that'll help out. So I want to thank you, all my listeners, again for listening to the show. Check in with us next week and have a great week, Huntsville and North Alabama.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844 888-343-6048.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.